Hello. Our next presentation will be from Michael Costa, Chief Executive Officer of Base Carbon Inc., which trades on the OTCQX market under the symbol BCBNF, as well as on the NEO market under the symbol BCBN. Welcome, Michael.
Thanks, everyone, and thanks, Water Tower. This is a super cool event, and really glad to be partnered with you guys and working with you guys going forward. There should be some forward-looking statements in there, so the normal disclaimers for everybody. But given it's our first time with the Water Tower investor base, we thought we'd just give a really simple overview of who we are as people, what Base Carbon is as a company, how we started, to really level set for everybody as we get into the environment and the ecosystem that you guys have and you guys are building. Very simply, Base Carbon, we're an upstream producer of voluntary carbon credits. Really, really simple business. We've got 3 projects that are on the books right now, 2 household device projects. I'll get into those and talk about what those are. 1 afforestation, reforestation project. And those projects either distribute clean cooking devices, plant trees, and by doing so, either reduce the amount of carbon in the atmosphere or actually sequester carbon out of the atmosphere. And in doing so, reduce the amount of carbon in the overall atmosphere. Very good for the environment, very good for net zero, very good for Paris Agreement 1.5 degree target goal. And the result of that is we have an economic widget that can be sold to all the net shorts in the marketplace, whether they be oil and gas companies, potentially even sovereigns, pursuant to Paris Agreement Article 6, yet to be adjudicated. So again, really, really simple business for us. From a high level, we're talking about upstream commodity producer, voluntary carbon markets. Right now, before we get into all the detail of our projects and what Base Carbon is, for me, as an ex-portfolio manager, and I'll get into my background in a second, I think framing the opportunity and what you need to believe right now to underwrite the story is really, really important, and where you believe their upside in the story. We trade for about a $35 million enterprise value on our. Sorry, I keep getting distracted. It's very distracting with the door. So for the people online, sorry about that. We have a $35 million US dollar enterprise value on one of our projects, on the phase 1 of our project in Vietnam, with a major US FI as our off-taker and Citibank. The remaining part of phase 1, which will happen over the next 12 to 18 months, will yield back to us, north of $30 million US dollars. So when you think about just a very simple sum of the parts as a get-go from where we trade right now, it's an incredibly compelling value proposition. I'll get into the projects themselves and talk a little bit about valuation, talk a little bit about the productivity of the projects, but fundamentally, we see not only the ability for multiples of money returns in the base case in our projects. There's certain upside case, positive risks in the market that we've exposed ourselves to in these projects. Talk about one of them in our Rwandan project that's actually, as of today, come to fruition, that we're really excited about. So this is a business where you don't really need to believe, and you don't really need to underwrite a lot to underwrite it at the current price. In the base case, there's lots of opportunity for multiple money return, and there's lots of exposure to upside. So in doing all of that, the question then becomes, well, who's doing all this? What are those upsides? What does this portfolio look like? What does Base do? So going back again to simple business, underwriting upstream projects, we're allocating capital in these projects. We raised to date about $50 million US dollars, 40 million of which we've allocated or committed across this portfolio of 3 main projects. In our team is comprised of people who come from carbon itself, people who come from finance, people who come from investing, portfolio management backgrounds. Carbon, what we've learned in a very short amount of time, is an industry which, and voluntary carbon specifically, requires a whole plethora of skill sets. There's not a skill set out there. So you need a risk management skill set. You need a deal process and due diligence skill set. You need an ongoing asset management skill set. And then on top of that, you need the carbon overlay, which I bifurcate into. You need the ability to develop projects. Have you actually developed projects, understand EM risk, understand how to manage those risks? And then number 2, do you actually understand the carbon markets? Do you understand the policy? Do you understand what's going to be valuable? One of the concerns within the VCM that we've seen is, and one of the what's the right way of saying this? The fallacies that we've seen others go about it as is they think about it as a commodity that they just go out and they create length. That doesn't make sense to us, and it never made sense. So we endeavored on this business to ensure that there was either offtake or no ability in our projects in terms of what the structural short in the carbon market was going to be and what we'd be delivering into. It wasn't just simply about, oh, let's go make some carbons and somebody will buy it someday. That's, we've learned or observed in other businesses and other capital allocation ventures that that's a really, really simple way to go bankrupt really, really quickly. And we did the opposite. We really focused on where the market was, where there was underwritability, where there was no ability, and we kept our portfolio really simple and avoided a lot of the flashy projects, and that's turned out to be really well for us. In terms of background on our business, for me, as I mentioned before, I'm an ex portfolio manager. I spent the first decade of my career at Goldman Sachs, just across the way here, but that building wasn't built when I started at Goldman. And I had hair back then. But I spent the first decade of my career there. I was primarily in a business called the Special Situations Group, largest on-balance sheet principal investing business within the firm. We did everything from specialty lending through to oil and gas finance and other commodity finance, through to buying derivatives from airlines, through to just common equity investing, middle market private equity, everything in between. So really capital structure agnostic, deal structure agnostic, industry agnostic, risk reward centric. We did things like build CLOs, which I think as time goes on in a business like this, I think is really, really important when you think about the tranching of risk that will need to happen for the voluntary market to grow into what it needs to grow into to meet the 1.5 degree goal pursuant to the Paris Agreement, and all of the different pieces of finance that will come together and equity finance that are necessary for that industry. From Goldman, I went to UBS. In SSG, I ran Goldman Sachs' Canadian investing business. So my portfolio was about $1.5 billion, give or take. I went from Goldman to UBS, ran their Canadian investing portfolio, similar size, $500 million side portfolio. And then I went to a family office where I managed all of their natural resource business during a transition within their business, as well as all their third-party asset management. So with me and with some of the team that I've built on my side, we have an incredibly risk-centric focus to our business, which you really don't see in A, junior companies, and B, in junior resource companies. The second part of our team it's going out and getting the skill sets of best in class to be able to deliver projects. So our chief legal officer is ex-McCarthy's. My business partner, who is the president of our business, is a ex-CEO of a $1 billion plus enterprise value public crypto miner prior to this. So we've got lots of experience in public markets, lots of experience governing public companies, lots of experience managing risk. And so for me as an ex-PM sitting across the table for many years from junior companies, that you sit there and you say, well, there's a great value proposition, but how do I really underwrite this? We went about building this business with how do we prove not to just ourselves as principals, but to our shareholders that there's really underwritability and knowability in what we're doing. And the proof's in the pudding. So we took this business public about 18 months ago, a little bit over 18 months ago. And in that period of time, if you comp it to most junior market businesses, and particularly most junior market resource businesses, again, I sat across the table from all these guys. They require further equity capital to get their project going. They're reliant upon equity capital to drive their business and to get to some optionality. I used to sort of joke they're liabilities at a level before they can be until they become assets. Our business isn't that. So in the 18 months that we've been public, we haven't raised an extra dollar. We've gone from $50 million of having raised capital to allocating well in excess of about 80% of that to projects. We generate revenue. We generate free cash flow from our key project. And we have productivity expected in 2024 from our Rwanda project, which I'll talk about in a second, and in 2025 from our India ARR project. So, we think about duration a lot, and we think about turning our book and how we do that thoughtfully and in a well underwritten manner. Over that time too, not only did we not issue shares to fund our business and became a resource company that generates free cash flow, but we actually repurchase shares. So we used a construct in Canada called the normal course issuer bid. It allows you to buy back shares at market, and we've bought back a significant number of shares. So we're now south of 120 million shares. Our peak was about just south of 130 million shares. So when you put that in context, it's just, I think it is a very unique situation within junior markets. The portfolio itself, I think, is at the end of the day, the meat and potatoes of what we do. People are important. People are what drive our business. Our best assets walking in and out the door every day. But our portfolio is what, sitting on your guys' side of the table, is going to be underwritten and understood, particularly in a base case, and then believing in the fact that and understanding the fact that there's a repeatability in what we're doing. So if you take our portfolio, you can really bifurcate it into two buckets: household devices and afforestation. We have two household device transactions, one in Rwanda, one in Vietnam. So household devices are really simple. When you think about, call it 1 billion people on the face of the earth, which is I didn't know this before I got into this business, but it's an insanely high number, and it's sort of makes you feel sad, a little bit of a number. But that's still either cook over an open fire, use an open fire to boil their water to make it potable, or to cook their food. 1 billion people. That's a lot of people. So in those families, mostly in low economic density areas, there's no access to all of the niceties that we enjoy in the Western world. So what we do is we distribute them a clean cooking device. So the benefit and the clean cooking device uses the same fuel source that they're using now, typically woody biomass, so trees, but it just burns. It's a really simple technology, but it just burns it a little bit more efficiently, and in many cases a lot more efficiently. So you're using much less biomass to make less BTUs, but those BTUs are focused in a way that you're getting the same utility, if you want to think about it out of the back end. That reduces the amount of carbon in the atmosphere. Really simple. These methodologies for projects like this have been around for the better part of 20 years. They go back to the Kyoto Protocol and the compliance markets, the CDM markets that came from that, and now pursuant to the VCM that's in existence right now, and will be part, in our view, and frankly, the industry's view, part of the offset portfolio as we think about how Article 6 and Paris Agreement is adjudicated. So our two transactions, and in Vietnam as well, we distribute water purifiers. So doesn't reduce the amount of wood you burn, eliminates the amount of wood. Other than the carbon side, there's a really, really high level of SDGs that come along with these projects. And fundamentally, what you're having happen is families need to spend less time away from home. Big win. Parents need to spend less time away from their kids. Big win. Way less. There's a lot of incidents, terribly, of rape and theft when people are walking really far away from where they live to go collect firewood because they know people are going to go there. Really big win. Biggest win is one of the biggest killers in the world is respiratory disease, not cancer or COVID or AIDS, but it's respiratory disease from breathing microparticles from fires day in, day out. So you're reducing the amount of that fine particulate matter because you're burning less stuff, and the stuff you burn is burned more efficiently and thoughtfully. Again, super big win. People have kids around these fires. So in our two projects in Rwanda and in Vietnam, this is a business. There's a duality in base between a for-profit and for-purpose, but there really is that duality. So let's talk about the profit side. In Vietnam, we have, as I've said, we have Citibank as our off-taker. So going back to the conversation before around underwritability and knowability, we didn't want to just go out and do projects that we thought made a lot of sense, but the ultimate shorts in the marketplace didn't. So Citibank's our off-taker for our first 7.4 million credits. We've tied together as closely as we can in our public disclosures what our pricing is in there. It's a fixed price, but you can effectively. I walked you through some of the numbers at the beginning, and you can back into really, really quickly what our price is. And as I said, for the back part of our contract, we'll net in and around $30 million for the back end of that phase one of that project. In addition to that, out the curve, if you want to think about it, we have effectively a call option. So we have a right, but not an obligation, no capital intensity to purchase credits. And those credits, as we stand right now in a quote unquote bad carbon market without any kind of upside relative to Paris Agreement, those would be in the money. So, again, you're getting no value in the equity or anywhere even close, and you're certainly not getting paid for the optionality. In Rwanda, we have 7.5 million credits that were effectively more of like a structured financier on. The first 2.2 at an indicative price, and I'm not saying that this is the price for anybody, but at an indicative one, because this is what we put in our public disclosure. At an indicative price of 10, we'd enjoy about 90% of that profitability of those credits. And on the first 2.2 million and on the back 5.3 million, we'd enjoy about 30% of that. So when you think about that in context in Rwanda, and we put about 10 million bucks out the door in Rwanda. So on all of our deals on the household device side have been structured with really short durations that we can turn our capital quickly, bring our value at risk to zero. And we did it with project partners in both Vietnam and Rwanda that had done it before. For those in the audience that are natural resource investors, everything is sort of brownfield, quote unquote, to us. They've distributed stoves before. They've worked with the local charities or women's unions to distribute. They've generated carbon credits. We didn't want to underwrite either in ourselves or other people somebody doing something for the first time. That just never made sense for us. And so that knowability and that underwritability was really important in that project and those projects in general. I made allusion at the beginning to the conversation around upside relative to Paris Agreement. There's a lot of technicality in what I'm about to say for a really short presentation, and for a lot of folks, the first time that they're hearing about BASE. But really simply, when you think about Paris Agreement, which is the multinational, multilateral agreement between 206 countries to reduce the world's temperature by it's the legislation from an international standpoint to make sure that we don't really mess up the atmosphere. If you want to go through the math, we can go through it afterwards. Put it really simply. Article 6, which you may read about in the news, is a really, really important part of that legislation is the wrong word, of that agreement. And that is the part of the agreement that helps adjudicate how credits go from one country to another country. So think about Paris really simply as cap and trade, but between countries, as opposed to a compliance regime within a country that forces companies to cap and trade. So within there, the question is, how do you get credits if I'm XYZ oil and gas producer that has a structural short in carbon, and I'm buying credits to offset my portfolio in the United States, in China, in a large industrial country, in India? How do I know that those credits, if I'm buying them from Rwanda or Vietnam, how do I know that those credits can be included in the nationally defined contribution in the amount of the cap and trade of that country versus the cap and trade of the country that you've come from? It's really hard. Who's going to get to count it? So the countries can give what's called a corresponding adjustment that says, hey, I'm giving you a stamp, I'm giving you a passport that allows these tons to leave my universe out of my cap. You can use them elsewhere. As of today, we have one of the first corresponding adjusted credit projects in our project in Rwanda. On that project itself, we've been merchant. We invested in that project about 18 months ago, 18 to 20 months ago from where we're at now. And we had the ability to go out and seek off-takers, and we didn't. And the reason we didn't is that we had an incredibly strong view around the corresponding adjustment capability of that country. We underwrote and looked at so many deals in other countries, and we had a very, very strong conviction. And as I keep talking about underwritability, that there were the potential of CAs. Where CAs matter is that if you're an oil and gas company or a structural short in carbon, I keep picking on the oil and gas producers, but you're a structural short in carbon for whatever reason, and you're going to buy offsets, having a correspondingly adjusted credit allows you to have certainty that that credit's not going to get pulled back in by the host country's government and say, no, that wasn't supposed to leave our borders. So if you have operations in that country that you're offsetting, that's really easy. But most of the time, where you think about where carbon credits are generated versus where they're consumed, where industry is versus where you either have density of low economic populations, you have the ability to plant trees in our instance, those aren't the same. So the ability to have that corresponding adjustment is really, really important, and there's an incredible follow through on price. So we've been merchant on that. We'll now that we have the corresponding adjustment, which we're really happy about, we're really grateful for, and we're really grateful to the government of Rwanda for the amount of time and energy and work that they put in. It's really they did we've taken a secondary role to our project partner Del Agua, who's done great work. But we're, both of them, it's very trailblazing and it's very necessary for the carbon world. But economically, when you sit here and say, well, hold on a second, I'm just learning about what a carbon is. The punchline means price is going to be a lot higher. That's good for us as a business. That's our household device part of our portfolio. The most recent transaction that we underwrote is a afforestation reforestation deal in northern India. So that means really simply, we're planting trees. We're planting, which is a good thing. That I have children now, and for me, helping, and this is the God's honest truth, like helping families that have children that are breathing smoke over their fire, or planting trees in a world that for my kids and our kids and going, like, I think that that's just a good thing. And I think that doing it in a business where that's duality of for profit and for purpose is really important. And you don't either have to be a charity and make no money, or just be a business and be profit focused. We get to do both, which is an absolute joy. Within our project, as I said, we're planting. We've committed low teens amount of capital. Our value at risk is much lower. I'd call our value at risk probably about $8 million, give or take, because we have certain CPs that need to be met within the project that totally de-risk it for that additional capital. We're planting 6.5 million trees. We'll generate about 1.6, 1.7 million credits from the planting of those trees. The volume of credits, if you think about the amount of credits I've talked about on the household device side, the volume of credits is way lower, but they're much more valuable because you're talking about sequestration, pulling carbon out of the atmosphere as opposed to just abating it. We've already had two. So we completed that transaction about 2 quarters ago. We've already had 2 unsolicited buyers come to us looking to price it and have a discussion. We're really interested in prepays. We're fairly uninterested in offtake on that one out the curve because it's effectively a 20-year project. And clearly, where we're trading right now, which is a great opportunity for those sitting in the audience. But if we're not getting a great PV in our common equity for it, I'm not that interested in offtake out the curve, but I'm really interested in prepay. We had a lot of line of sight on what the market would look like through our project partner, Valley Network Advisors, VNV, who are, I'd say, the preeminent project developer within the voluntary carbon market. They have 19 producing projects. They have another 75 projects in the works. And so this project is really, really high quality, as evidenced by the fact that we're getting phone calls already. And it's effectively smallholder land, 5 hectare or less farmers. So this isn't big tracts of land that you're going out there and you're trying to do plantation farming on. These are farmers. The farmers are doing a lot of the planting themselves, not because it's free labor, but because they know their land. They know where they want to plant the trees. They know how, we help them on the specific species of trees plant. We also help them plant fruit and nut trees on the land. We help with irrigation. So they love it to help with irrigation. That's outside of the monsoon season. They love it because we're giving them a cash crop that's not tied to seasonality. There is seasonality, but you have some smoothing because there's fruit and nut trees of what we're planting. And they love it because it keeps water in the groundwater with our trees as well. So really, really high quality projects. As we transition this business and as we think about the build within, step one for us is really thinking about abatements. If you want to think about it like a power producer, they're great projects, but you have to have the right mix, to us, and they're great economic returns. When I think as an investor across the returns that are available in the marketplace, if you think about our Vietnam project, we committed $20 million of capital. We've recouped 6 already. And as I've said, we're talking about another $30 million, give or take, over the next 12 to 18 months. Those are incredible returns. And with a very, very low chance of capital overrun, given the nature of the capital allocation. We're not naive though. There has to be an incredible right mix to do those projects. So we'll continue to do abatement projects, but we'll do them as and when they're available. The base load of our business will be ARR projects. And then as time goes on into technologies like direct air capture, we just don't think they're there yet. We're happy to pay 10 times, 100 times what they're worth right now in the marketplace to make sure that, again, there is, as I keep talking about here, there's underwritability in what we're allocating our capital and our shareholders' capital in the business to. The last thing I'd say, I think you can probably tell we're pretty passionate about this business. We're pretty passionate about the business in general, but also base carbon. We're big principals as well. Myself and my co-founder, Fulford, we've written big checks into the business. We'll continue to write checks. We've spun it out of the business, Avex Technologies, that I was a co-founder of. Abex is commercializing a fully DeFi LNG exchange and commodity exchange in Singapore. They actually today they got their well, good news for you guys today. They were granted their operating licenses by the Monetary Authority of Singapore. So for their exchange and their clearinghouse, which is really, really exciting. I'm just a shareholder there. They're a big shareholder of mine. I'm a shareholder there, but we're very excited about that. So it's we've got a really powerful ecosystem of people. We've got a really pedigreed background of thinking about risk, and we've got a really cool portfolio and similar expected return deals. So.
Michael, sorry to interrupt. We're getting close to time.
If you gave me 10 more seconds, I would have stopped talking for you.
Wonderful. Any questions from the audience? All right, Graham.
Can you just talk about how you source the projects or how competitive it is as you're looking at them, and then also talk about in terms of finding people to buy the credits on the other side?
Yeah, totally. So sourcing is incredibly important. It's I think it's a black and white bar whether you can underwrite or not. But then the question is, do you have enough flow to put through your engine to be able to underwrite properly to find the best deals out there? So if you're just waiting for a deal to walk in and then you're evaluating it, I don't actually think you're underwriting, because I think that sourcing engine is really important. For us, what we've realized in Carbon is that there's a lot of really, really early stage projects out there that could be great, but I don't want it. The duration is really long. So we are working with developers that have done it before. And I think it's evidenced by our book. All three of our developers have developed tons of projects before. They're the ones spending small dollars, 50, 100,000 bucks to get a project. It's really less about the capital, but more about the duration and the focus to get a project to the point where it's like, I'd call it lowercase b, but bankable. That's where we're really focused in this market. And I think that from a sourcing standpoint, there's a lot of, I'm very interested in the repeatability of all of our project developers. I'm not going to do a deal with a project developer, and we as a business aren't going to do a deal unless we think there's a lot of repeatability back to what they're doing, largely because we're underwriting them just as much as the project itself. So it's sort of like almost like a dual tiered sourcing model of sourcing developers, and then as a function of that, sourcing projects that they've proven up, to use some resource language, to a level of semi bankability for us. On the offtake side is way harder, but it's way more interesting too. So this is a market that is it will commoditize, but it's not commoditized yet. Think about it like oil, but with all of the differentials with oil, but there's no benchmarks and there's no curves, right? So and there's like 9,000 different differentials and specs and so it's almost, think about like oil versus all of the ways a barrel can be cracked, and then all of the diffs on that, and just like it makes your eyes spin. But you don't have 100 years to adjudicate what that marketplace looks like and the financialization. So it's all equity finance. There's not a forward curve. That's really good for us in a way, because it gives our ability to price things is incredible. Where it's really bad is that from an underwriting standpoint, you can't go out and just wash and repeat off and over and over and over again. You got to be really thoughtful, and you got to be really thoughtful where you're using your ultimate last dollar equity risk and where you're using your sort of merchant capital, if you want to think about it. In terms of off-takers, again, I think about it more like an ecosystem instead of, we don't have a dedicated sales and trading effort. There's people that do that. We might think about partnerships with those people over time, but we can, without any ego, but there's not many boardrooms that we haven't either been in as a group or we can't be in as a group. So it's more around us I don't want to have to go out on every deal and source a buyer. That's an utter waste of time in our business and not where we have edge. Other people have edge doing that. So it's where do we have relationship within our ecosystem, and how do we partner with the parties, whether it be a developer that has some of those relationships or a firm that actually does that activity, and pay them a fair wage for their skills and services and risk, and just be out of that business. But for us, we have to have a hand in it right now until the market commoditizes just a bit more.
All right, Michael, thank you for your time. I think that's it for today.
Thanks, everybody.